Most people think retirement is just about hitting a big number. Once their portfolio hits 1 or 2 or 5 million, they'll be set. But they spend no time actually figuring out how to transform that number into a retirement paycheck, a reliable, flexible, and tax-efficient, steady stream of income. And that is the key to a retirement that succeeds versus one that fails. So today, we are covering exactly that and also walking through a case study so you can see how this works in a real retirement scenario. By the way, I'm Rachel Camp. I am a CFP professional and the founder of Camp Wealth, and we help people confidently retire before age 65. Today, we are going to talk about your retirement income in the form of different levels. Level 1 being your foundation, your stability. And in the foundation level, we have predictable income. And this form of income is incredibly effective in making sure your retirement survives. But most importantly, some of these retirement income sources can protect against the big 3 risks. Let's call them the triple threat. That's low returns, high inflation, and living a long time. The first income source that actually does a fairly good job protecting you against all 3 of these risks is Social Security. Social Security, for how it should work, it has a built-in inflation adjustment, should never be cut even in down markets, and will be there as long as you're alive. Now, I know many of you may disagree with me on that point, but I'm explaining it in a way that Social Security is designed to work and has historically worked so far. If you think the future looks different than history, you can use more conservative assumptions. The second source of stable income is now rare to have, but incredibly valuable if you do, and that is pensions. If your workplace benefits included a pension, you now have a reliable source of income, usually through the rest of your life. You should check if there is an inflation adjustment because I noticed that many pensions don't actually adjust for inflation and they instead just pay a fixed amount. You should also check if you have a lump sum option with the pension and compare that to the lifetime stream of income or taking that lump sum and investing it and see what the better deal is for you. Finally, the last retirement income that makes up our foundation level is annuities. Yes, the dreaded word annuity. And no, they're actually not always bad. Some people will choose to take their investments and rather than submit it to stock market volatility, would prefer to take it to an insurance company and receive a guaranteed stream of income for their life. If you understand the product, what you are potentially giving up, and any direct or indirect fees, you should be able to make an informed decision here for yourself. But be careful in this realm. These products are often oversold and intentionally complex. The foundation level of retirement income is powerful because it's stable and often immune to stock market volatility. One of the best benefits I find with the foundation level is psychological. The stability of income a retiree can rely on creates massive peace of mind. But for some people, they can handle more volatility and are willing to pay that price for higher returns. That's where we get into level 2. Level 2 of retirement income is portfolio income. This income, compared to level 1, our foundation, level 2 is more variable. There is no insurance company backing this up. There's no government backing this up. You are in charge of your paycheck for level 2. As a result, if you do it right, your potential for a higher income actually increases. You have 2 very powerful strategies in level 2, and most people don't use them to their fullest advantage. Strategy number 1 here is your withdrawal strategy. The most popular withdrawal strategy is the 4% rule. That says you can take 4% from your portfolio and adjust the inflation every year. With a 30-year time horizon, you have little chance of running out of money. But the 4% rule is often overly conservative, meaning you are likely spending way less than you potentially could. And this is where we have dynamic withdrawal strategies come in, but you have to understand their rules and know when to adjust. One of my favorites is the ratcheting strategy, which establishes a floor, an income floor, which your income can never drop below. But it gives you a spending increase if and when your portfolio does well. A lot of people are a fan of Jonathan Guyton's guardrail strategy. This strategy starts a low and high guardrail that triggers a spending change like 4% and 6%. If your portfolio does really well and your withdrawal rate drops below 4%, you give yourself a spending increase. If, on the other hand, you enter a bad market and portfolio value decreases, withdrawal rate increases above 6%, you actually give yourself a spending cut. These dynamic withdrawal strategies can be really powerful in allowing you to spend more while surviving down markets. But the second strategy you need to know at level 2 is, in my opinion, even more powerful. Strategy number 2 is a tax-efficient withdrawal strategy. In level 2 of portfolio income, we have a lot of control over taxes compared to level 1. The downside of level 1 is once you turn on the income stream, you have very little control over it. You can't turn it off even if you don't need that income. So you'll continue to pay tax on the income stream no matter what. But in level 2, you are almost entirely in charge, and I'll explain where you aren't in charge. If we look at the portfolio divided into 3 tax buckets plus a bonus bucket. So bucket number 1 is your taxable bucket. You can lump your checking, savings, and brokerage accounts into this bucket. On these accounts, you pay tax as you go on the dividends and interest being generated. But outside of that, you don't pay tax until you sell an investment with a gain. At that point, you will pay tax just on the gain. But you will be using the capital gains tax bracket, not your ordinary income tax bracket. In my example later with the case study, I will show you what that looks like. Now, bucket number 2 is your pre-tax bucket. This is your traditional IRAs, 401ks, 403bs, SEP IRAs, simple IRAs, if you have them. And all of this money went into the account pre-tax and grows tax-deferred and will only be taxed when you take the money out of these accounts. This is taxed at your ordinary income tax bracket. Now, bucket number 3 is your tax-free bucket, and this is all of your Roth accounts. The Roth 401k, 403b, Roth IRAs, all of this money went into the account with taxes already being paid, and now it is growing tax-free and will come out tax-free if you follow the rules. Finally, I have to mention the bonus bucket because this has a triple tax advantage. The HSA or health savings account goes in tax-free, grows tax-free, and will come out tax-free for qualified medical expenses. Super powerful account, especially when we think about the cost of healthcare as you age. Now, with these 3 buckets plus the bonus, you have maximum control over your tax impact. A powerful strategy for early retirement is Roth conversion, filling up the standard deduction amount, and then using the brokerage account for your income, making sure you stay in the 0% capital gains tax bracket. If that sounds confusing, it'll make more sense in my example at the end. Now, our final level for retirement income may be the most impactful. Level 3 could also be seen as the bonus layer because a lot of retirees won't have this. You may not need it, but I'm seeing more and more retirees actually use this level to phase into retirement, and it's active income. And there are different types here. Some of my clients own rental properties and choose to continue holding them in retirement. While technically considered passive income for tax purposes, it certainly can feel active if you are the manager of these properties. Now, the benefit of rental income is it does often adjust with inflation. But what I see most often with this third level is my clients deciding to move to part-time work or consulting rather than fully retiring. And often not because they feel they have to, and sometimes they might, but because they want to. I like to call this phase work optional, chasing the projects and ideas that excite you rather than worrying about how much they're going to pay you. This phase of life could be the most fulfilling part of your career. From a tax standpoint, you'll need to be careful when you take Social Security if you decide to keep working because it can cut your benefits. The active level, if you decide to keep working, can allow for your portfolio to keep growing instead of tapping into it, and it could help you survive a poor sequence of returns risk early in retirement. Now, let's tie these 3 levels together with an example so you can see how this works in the real world. Michael and Holly Scott are retiring at age 55, and they want a solid retirement income strategy. They want one that is tax optimized, stable, and allows them to spend lavishly on the things they want to, like vacations and spoiling their grandchildren. So we're going to walk through this, what we'll call stage 1 of their retirement. This is from age 55 to 60 for them. So for this stage 1, Michael and Holly decide they want to live off their taxable brokerage account that they have, staying in the 0% capital gains bracket while doing Roth conversions so they can avoid massive RMDs later on when they get to that age. So in their brokerage account that has 50% unrealized gains in it, and they need $80K in income every year. All right, so I'm going to walk through stage 1 here. Ignore this tax year 2024, completely unrelated. I just couldn't get couldn't get it out of the page. So walking through stage one, this is Michael and Holly Scott. So no wages, of course, but we're going through and they're going to fill up their standard deduction. That's $33,200 with the Roth conversion, like I mentioned. And then they are going to take their income from the brokerage account. So they need $80,000. So that is $40,000 for gains, right? Because I said it's a 50% unrealized gain. So we're reporting $40,000 there. And you can see, we'll jump to the tax report here. So they are actually staying in the 10% bracket. They're staying in the 0% capital gains bracket. One important thing here to note is actually they have more room within the 0% capital gains bracket. So we could do something called tax gain harvesting, where we could fill that up a bit more for the brokerage account. Another thing to note with stage one is they could be more aggressive and fill up the 10% bracket with Roth conversions as well. That could be an option. Just showing you a simple example here, but certainly room for optimization. All right, so for stage two of their retirement, this is going to be from ages 60 to 66 for them, and a pension for Holly is actually going to start. So we will not be turning away free money, so we will turn that pension on. What's going to happen with the pension is that does reduce the burden of the portfolio, and it forces us to adjust our tax strategy a bit now that that has started. With inflation adjustments, by the time they get to age 60, we're going to assume they now need $90,000 in income instead of $80,000. So with a $20,000 pension, we now need $70,000 from the brokerage account. So looking at stage two now, you'll notice we now have the pension in here. We are still doing Roth conversions. The capital gains that we're reporting here has gone down because now we only need $70,000, although it adjusted for inflation as well, like I mentioned. So now if we go to the tax report, we will see they are still in the 10% bracket, although they're up there quite a bit now, and still in the 0% bracket here too. So again, additional opportunity for them if they wanted to fill up the 10 or 12% with Roth conversions, and also additional opportunity for tax gain harvesting. But in these first two stages of retirement, their taxes are extremely low. Now, stage three for Holly and Michael is our Social Security stage. So they decide at full retirement age 67, that they both want to turn on Social Security. We're going to say their combined benefit is $65,000. Their income need this year with inflation adjustments is $108,000. Now, at this point, we're actually going to assume the taxable account has been depleted, which is fine. Now we need Social Security, Holly's pensions, and now we're going to need a little from Holly's IRA, about $23,000 to get us to their full amount. Something to keep in mind, again, this is a simplified example, but if they need to spend $108,000 net after taxes, we'll have to take up more to make up for taxes. All right, so in stage three, you can see we are taking some from Holly's IRA. So we do have IRA distributions of $23,000. We still have our pension. It's a fixed amount, so it's staying there. We are now adding Social Security, so that is getting taxed as well. $32,000 of it is now taxable. If we go to the tax report, they are now in the 12% bracket, still very low for ordinary income, and their Social Security is starting to be taxed, like I mentioned. If we scroll all the way down on these different stages, you'll see they paid no taxes in stage one, $2,000 in taxes in stage two, and just $4,600 in taxes in stage three. Extremely tax efficient. And we're not going to say no again to that foundation level type of income, but now it does remove some of the flexibility with taxes at these different stages. Finally, stage four is our RMD stage. This starts at age 75 for them. At this point, they have been steadily doing Roth conversions for years, so their RMDs will not be more than they need. And with RMDs, Social Security, the pension, and supplemental withdrawals from their Roths, they'll stay in a low tax bracket and have a secure retirement income through the rest of their life. Now that you understand the complete spectrum of retirement income sources available to you, you can use this information to create a truly comprehensive strategy that maximizes your monthly cash flow through retirement. If you want personalized guidance on optimizing your retirement income strategy, click the link in the description to book a call with me. I will analyze your current retirement approach and show you exactly how to integrate these various income sources for maximum financial security in your golden years. I'll see you in the next video.